So I wanted to start really honestly bare bones, and it might be a little bit too, you guys might already know about it, but I wanted to go over it anyway. And that is basically just tax brackets in general and how they work. So let's say that I'm single and I make $200,000. So I would fall into the 32% tax bracket. Is my $200,000 taxed at 32%? No. You don't multiply that percentage by the whole amount. It's by increments. So the only portion that's taxed at the 32% is the amount that goes above that 197. So everything else is taxed in its own bracket. Now when you're self-employed, you get taxed at these tax brackets plus at 15.3% on top of that. That is self-employment tax. Another way to say this is payroll tax. You don't have payroll because you're your employee and your employer. When you do have a W-2 job, your employer pays 7.5% and you pay 7.5%. This isn't including the federal income taxes. This is the Medicare and Social Security, right? Or FICA taxes. So when you're your own employer and employee, you pay both halves. And they changed the name from payroll tax to self-employment tax. And so that's where that additional 15.3% comes in. So there's hope. So fear not. We'll go over that. Every time everyone's like, oh, well, that sucks. But we'll go over not only how to reduce that, different strategies to reduce that, but also some other benefits that you get from being self-employed as well, because there are benefits to being self-employed versus a W-2 job. So we'll go over it. So deductions versus credits. This is another one that's a little elementary, but I wanted to go over it because just in case that there's a misunderstanding there. Deductions take away from your taxable income. Your tax is not determined until you get to your taxable income. So you may earn $200,000, but I have a standard deduction, which we'll go over in a minute. That takes away from my total income. I've got other deductions that I can take away, and that lowers my taxable income. So deductions help with your with your tax indirectly. Credits, one of the probably most popular one is the child tax credit. Who has children here? Yeah. So child tax credit, it deducts it directly from the tax that you owe. So depending on the credit, it could be more beneficial than a deduction. Sometimes not, depending on how big your deduction is. But they both help with lowering it. They're just both a little bit different. So the standard deduction is a specified amount that the IRS every year says, all right, you're in one of these situations, this filing status, you get to have this much of a deduction this year. You don't have to do anything for it, we're just giving it to you. And so for single 424, it's 14.6, 21.9 for head of household, with basically means that you're single but you have a child or dependents, and married filing jointly, which is 29.2. This has been incrementally going up over the last couple years. Now, it used to be, before the Tax and Job Cut Act, whatever Trump did in 2017, right? Yes, it was half of that. What you were able to do was itemize much more. It was easier to itemize back then, but your standardized deduction was lower. So even if you didn't have enough things to itemize, you still got a standard deduction, but it was lower. In 2018, they changed that, and they made it so that the standardized deduction was much higher, but it's also much more difficult to itemize now. And there is a misconception there where people think, oh, I'm not able to itemize anymore, I'm missing out. Well, the way you get to itemize is adding up all of your costs that you have throughout the year, and there's 4 basic costs for that, right? So you have medical expenses that aren't reimbursed, state taxes that you pay, where it's like real estate tax, personal property, things like that, income tax. your home mortgage interest and points that you pay does count towards interest in this portion, and charitable contributions. Those are the four main things that you can add up to get to be more than your respective category, right? So if you're married filing jointly and your mortgage isn't, or your mortgage interest isn't $19,000, then you're probably not going to itemize. But you still get the standardized deduction. So even if you can't add up all your things to itemize, you're still getting whichever one is the better deal for you. You're getting the higher one no matter what. Now, this is for personal only. This is what goes on the Schedule A, which is the personal deductions. This is not where your business expenses go, and this has nothing to do with your business expenses. Selena, you were asking about using your other business expenses that you have that aren't reimbursed to add to your standardized deduction. There are a few that you can use, and what I was just going over with them is that they cut out a lot of the things that you can use to itemize. So there's not a lot. There is a small section at the bottom for miscellaneous deductions. There's not a whole lot that you can use there. A lot of that is reserved for like military, like active duty military, like they can use moving expenses or some food expenses and travel and things like that. That's not reimbursed, or some uniform that's not reimbursed. A lot of other W-2s, there's not a whole lot that you can deduct outside of that.
There's like a $200 teacher one, right?
Yes, so if you are a teacher, and that doesn't go here, that goes on a different schedule, but yes, you are able to deduct expenses that you buy outside of the school, because that's very common for teachers. They're not given money to go, like the school doesn't pay for that stuff. The teacher pays for it, or they get donations from the parents. So they can do up to $300. Yeah. That also changes every year. So at one point it was $200, so you're right. Yes. So yes, you can take things like that. But Selena, we can talk after about things that more specifically that you're looking at and see if we can do that for you. All right, so you all own your own business. And so when you do, this is one of the things that's good about owning a business and being self-employed, is that you can take deductions off of your income, and that's going to be through a Schedule C or a separate tax return depending on your entity structure. And we're going to go over specifically what that's going to look like and things that you can deduct, and hopefully give you guys some new ideas or confirm things that you already know. And if you have any questions, please feel free to chirp in that time, because that's a very broad area and there's a lot of gray area in there too. So we want to make sure that we answer any of those questions, and I'm pretty sure I'll answer some of them with the slides that I've got too. All right, so question marks. So there are different entity options, right? If you want to just use your social security number and be a sole proprietor, that's totally fine. That is going to go on a Schedule C on your personal tax return, which is the 1040. If you want to be an LLC, what that does is that's not necessarily a tax filing status. What that is a legal status where you are legally separating yourself and protecting yourself against anything that would come against the entity. You're separating your entity from yourself. That's why it's very important to get a bank account separate, because when you intermingle personal with business, that's called piercing the veil of the LLC. And you want to be very careful of doing that, because if someone does come after you and they question the validity of your LLC and they see that you're doing all these personal things or anything else that could pierce the veil, then they're going to say, well, you're not separate from your entity, so I'm going to come after you. And they could do that. I'm not a lawyer, so I'm just saying, but that's the idea behind that. These first two options are both disregarded entities for the IRS. That means they both get filed the same way on a Schedule C on your 1040. The IRS doesn't care if you're separate from your entity because they know that you made that money, right? Now we're going into the other three options, big options. I'm going to stick with the top two. A C corporation, that is where you want to go public on the stock market and things like that. Don't think we're at that level, right? And it's usually not a good idea, especially if you're starting out or not making millions of dollars. Let's steer away from that. We're going to talk about partnership and S corporation. That's where you guys are going to want to stick with. Partnership is sole proprietorship plus multiple people, right? And it's just divided amongst you. You want to have an agreement written up with that and make it legal. And you will file a separate tax return for that. When you get a separate tax return filed, then you get basically a form called a K-1, and that separates, and say you have a 50-50 partnership. Once you file that 1065 tax return, you figure out the net income for that after all the business expenses are taken out. And this person gets 50% on the K-1, and this person gets 50% on the K-1, and that's what they use to file their own taxes with. They don't have to claim full income on there. When you are in a partnership and you're a general partner, which means you're actively participating in it, you still pay self-employment taxes. So that's important to remember. You can elect to go from being an LLC or a partnership to being an S corporation. All that's doing is saying that I'm electing to be taxed as an S corporation. It doesn't get rid of the LLC, so you're still protected legally. Because remember, the LLC isn't tax filing. You're just separating now your taxes from yourself. And when you're an S corporation, you are going to be filing a different tax return, similar to that partnership, right? So all the shareholders, if you're 100%, you're a sole proprietor, you're still 100% of a shareholder. Or if you have multiple people in there, it's, again, you're going to get a K-1, and it's going to be, you only have to file your share on your personal tax return. But everything is calculated on the side in a separate tax return as far as getting your business income growth, taking all the expenses out, and getting the net income. Any questions so far?
For agents,
Yep.
I mean, would this ever apply? Would it be for teams or something?
Yes.
I was told I should absolutely be doing an S corp just based on the money that I'm making, because I don't need I don't know how to say this. I don't need as much money as I'm making.
Yes.
That sounds terrible.
I will explain that a little bit better, but not much better. I'll explain that a little bit better though. So we'll go over that, and let's say, like, why would I ever want to do an S corp? Is that going to be worth it for me?
Right.
There's a point in time where it will be. Hopefully, it will be worth it for you, and we're going to go over that, I think, on the next slide.
I am, but
So
I don't mean it like that. But if otherwise I have to pay taxes on the whole amount.
Yeah.
Well, I know
Yep.
you'll explain it better.
You got it.
Best for your
Right.
Yep.
And and then putting into step. And I mean, I got the rundown from my the school financial person for all the things I should be doing that I'm not. So.
All right, so this is just explaining again what the main tax forms are that you would look at, right? So if you're self-employed, now this is whether you are a S corp, an LLC, or a sole proprietor. If you are self-employed or a contract employee, then you're going to receive at the end of the year, or not the end of the year, at the beginning of the next year, right? A 1099 NEC, which is non-employment compensation. A 1099-K, which you get for making credit card transactions, or a 1099 miscellaneous, which you can receive for various income, including rental income. I did include a few slides in here on rental income just because it's kind of related, and you guys might want to venture into doing that too, just to give you an idea. W-2s may be received by regular employees, we all know that, but also statutory employees. So real estate agents really technically most of the time are statutory employees, which means that they're like kind of in the middle, right? They're not completely devoted, I should say, or stuck in the employer where they're on their time and using all of their equipment and doing things the way that they have by their standards, but they're not completely self-employed either, where they have the free range and can go work for a bunch of different brokerages at once and things like that. But if you are a realtor and receiving a 1099 as a self-employed individual, then there's no difference filing wise. But just to say that when you're a statutory employee, you can still include expenses against that income. It doesn't mean because you got a W-2 that you can't put anything against that. We went over the filing form. So self-employment, sole proprietors, LLCs, they go on the personal tax return, and you can reduce your net income there. S corps and partnerships go on their own respective forms. Those are pass-through entities, which a pass-through entity is basically meaning they formulate and you file. The 1120S and 1065 are pretty much informational, so that the IRS can see how much the business made, and then it gets passed through to the shareholders or the partners with their respective share of the income. And you, from that pass-through income, you report that on your own personal tax return. Hi there.
Hi.
Okay, so I wanted to point out too, this is important, and hopefully you all know this already. If not, we're going to make sure that you're prepared for 2025's tax year, right? Because it's a little too late for 24. But if you have self-employment income, your taxes are not withheld. So when you're an employee, like we were saying before, W-2s, you have your payroll taxes that are paid. That has to be paid. But you also get the W-4 at the beginning of your employment, and you decide how much you want to have withheld for your federal taxes. There's no federal taxes that are going to be withheld from you unless it's a specific situation where you should be able to request that, but that doesn't always happen. Just be prepared for that. So here is where we were talking just a moment ago about when is it going to be realistic for me to be an S corporation? When is that going to be beneficial to me? So when you're making income, and we're talking about net income. Net income, just as a reminder, that's when you take your total sales for the year, you subtract all of your expenses that you can, and you get to your net income. The net income comes up here, and we have we would say $100,000 in this example. This is a sole proprietor or an LLC. So we are going to report all of our net income on our 1040. All of that is subject to that 15.3% of self-employment tax on top of the regular tax rate that we went over before. And so you're paying an additional $15,000 in taxes on top of your regular taxes. If you're an S Corp, what that's going to do is it's going to still take that net income. We're still at $100,000, right? The biggest difference between self-employed with just sole proprietor and an LLC versus the S Corp is you're required now that you're in an S Corp and you're a shareholder, you're required to be on payroll. So you have to pay yourself a W-2. That W-2 has to be in the amount that's called reasonable compensation, which is basically the fair market value of your position, which goes into what you were saying before is you come up with this figure. Always keep a journal entry on how you got this. Keep your records for how you found this, but you can use Glassdoor, things like that to find out what is the nationwide average salary, or for my area, what's the salary for a real estate agent. Let's say it's $60,000. I'm making numbers up, but
Not 30.
no, we'll say 30. We'll say 30. It's not that one. We'll see if that's reasonable. Let's say they do this 50% of the time, right? Because you also take that into consideration. How much of your time are you spending doing this? Let's say I have a W-2 job and on the side I'm doing the real estate. So 30 is now reasonable, and I can confidently say that. So you're paying your self-employment or payroll taxes on that $30,000, not on the $100,000, because you're satisfying the IRS's requirement of being on payroll and paying your payroll taxes there. So you've paid that. Now you get to deduct that salary from your net income, because now that's an expense. Wages are expenses. And that brings your net income to $70,000. So let's say you're the 100% shareholder in your S corporation. You get your K1. Remember, the K1 is going to have $70,000 on it. You're going to put it on your personal tax return now, just like you would a W-2 or a 1099 NEC. You put it and you say that I got $70,000 from my business. That $70,000 is not subject to self-employment tax. It's only subject to regular income taxes. So you're saving yourself 15.3% on $70,000. So you can see the tax savings down here for where that comes out. You saved yourself $10,000 simply from being an S Corp. Yes.
So since my husband and I filed jointly, and
yes.
You can tell me if we shouldn't be doing that anymore, but anyway.
90% of the time you should.
So when we're using this S Corp, and when we're looking at our whole for regular taxes,
yes,
our standard taxes. So then, is it on the 30 solely that the regular taxes are on, our reasonable salary?
So this is how this is going to work. So where did that $30,000 go? What was that for?
To pay myself.
Exactly. And you get a W-2. Okay. So you're going to report on your personal tax return. You're going to have a W-2. So you're reporting that you got $30,000.
Right.
And you're reporting the taxes that you paid throughout the year. And then you're going to report your K-1 with the rest of the 70. And that is going to make up the $100,000 that you made from the business.
Right.
So the only part of it, and you're not going to see that 15.3%, you're not going to see that at the end of the year anymore, because you're paying it throughout the year.
Okay.
Right? So that 15.3 essentially, it doesn't go away, but it's not like, oh, I've got this huge tax burden at the end of the year anymore. Right? So if you have
So moral of the story, it is still going to be on that 100,000.
It's still going to be on that 100.
Our married portfolio.
Yes. So on your 1040, I will pull up a tax form at the end for you, just so I can show you, because it's a tax form is nothing but a big old equation, right? And so it's easier to illustrate sometimes with that. So all the W-2 income goes on there, which if you're married filing jointly, all your husband's employment income is going on there, plus that $30,000 that you made. And then all of the other income is going to be on there. So if you have a rental property, if you have another side business, if your husband does DoorDash or whatever, like anything, and then plus that K1 is going to be in that portion, and that's all added together to get your AGI, your adjusted gross income.
Okay.
And then that's where your deductions come in, as far as like standard versus itemized deductions get taken away from that number. Okay? Do we have any other questions on this?
So basically, though, then there is absolutely no, in the S Corp situation, there's no self-employment, the 15.3%.
You're paying it in the form of you being an actual employee.
Salary.
Yeah. Mm-hmm. Yeah. Yep.
But it's already paid.
Exactly. So you don't have to, as long as you're paying your taxes on time throughout the year.
Well, because and please correct me.
Yes.
So if I'm doing a W-2, it's going to look just like it did when I was a teacher.
Yeah,
so
exactly.
It's going to be the federal withholding. It's
Yep.
going to be the Social Security.
Yep.
All of that's going to happen on my payroll.
Exactly.
And that's why I have to buy an app to do it.
Now, yes.
Right? Okay.
Or hire Patriots Tax and Accounting, and we do payroll as well. Yeah. But, so we do help with payroll. We help with bookkeeping and on all the other business things too. But, so you're right. So at the end of the year, you still fill out when you get set up on payroll, you do a W-4 for yourself. So you can still have tax withholding on that. The other thing too is that people think, oh, well, I'm only paying myself $30,000. That's not enough for me to live off of. Your reasonable salary is just to satisfy the IRS. It's got nothing to do with the amount of income that you can still take from your business, right? You can still take owner's draws, is what they're called now. And so again, I'm going to reiterate this, don't spend your business money on your personal things. Don't spend them directly from the business account. Take them, take whatever you need, transfer it to your personal account, and then spend it. That's going to be an owner's draw. You still want to take note of how much that is. You want to keep track of how much that is, but it's not a business expense. So keep that in mind. The only business expense as far as money that you're taking out of the business for your own self that can be deducted is your salary, because those are wages that you're paying taxes on.
But is that also the owner's draw?
No.
Salary?
No.
It's a separate thing?
It's separate. That's payroll. These are now wages.
Yeah.
You're an employee.
Owner's draw was,
Because if you're getting a W-2, you're an employee.
yeah.
Owner's draw is separate from that. That's just you saying, oh crap, I need another $200 this month, and you can transfer it out and take the $200. That can be however much you want to set it up with. That can be however much you might need. It can be whatever you want it to be, but pay attention.
Expenses?
No, it doesn't go anywhere.
Oh, okay.
No. The only thing that would affect is your balance sheet, which if you're making under $250,000, you really tax-wise don't have to really worry about a balance sheet. It doesn't have to get filed. So we're not going to talk about that right now.
So I'm going to ask you a business
Yes.
planning and less
Yeah.
tax. So, when this is set up and
Mhm.
the W-2s and
Yep.
all of that, can you also set it up so that like when my commission comes in, like that's all filed, but then I can also send it to a retirement account?
Yes.
Okay.
So that's
Like
a good point.
automatically, Without.
Yeah, that's part of you set that up as the owner, and it can be a part of payroll, like how an employer sets up 401k and medical benefits.
Okay.
It's the same thing. You can still set up the same thing, and those are tax deductible as a business expense now.
That's good.
So, and it reduces your taxable income as an employee. So those are win-wins. So I don't have slides on those. I didn't know if I wanted to go that far.
That would be like a paid service separately.
Yeah.
Okay.
So that's a business expense, because now these are employee benefits that I'm providing. So
But since they're a business expense, they are also tax deductible.
Mhm.
Yes.
exactly.
Okay.
So, yep. And there's a bunch of rules that spider on into that. But overall, yes. Any other questions on this before I move on?
Well,
Yes.
you said the owner's draw, that does
Yes.
not apply to sole proprietorship at all?
It's because it's disregarded.
Right.
IRS does not look at this as an entity.
Mm-hmm.
You're making your own money and you're reporting it on your personal tax return.
There's
So
no W-2 involved.
there's no W-2 involved in that. And so on the C schedule, it doesn't matter, and this is for both. I'll repeat, I'm going to say it and then I'm going to repeat myself for both situations. So if you are a sole proprietorship or an LLC, you report it on a Schedule C, and then whatever number is at the bottom after all expenses are taken out, that's your income, and you're paying taxes on that, and you're paying the 15.3% taxes on that, no matter how much you left in the business or took out.
It's considered all income.
Exactly. And that's the same thing for that remainder, that $70,000 in the S Corp. It doesn't matter if you didn't take any owner's draws on that. That's how much the business made. It's a pass-through entity. You're paying your regular taxes on that $70,000 if you touched it or not. Okay? Important things, tax deadlines. So if you are filing the 1120S, which is the S Corporation return, or the 1065, your due date is coming up vastly. It's coming up quickly in March, in just a couple weeks. Tax return deadlines for the 1040, which is a regular tax return, is going to be on April 15th. I think we all pretty much know that, but just in case you didn't, I threw it up there. If you need some extra time, you can file an extension for both the 1120S 1065 or the 1040. You can file an extension and get yourself an additional 6 months time to file. The only thing this really does is avoid the late filing penalty. If you owe taxes, you are still liable to pay that really in the year that you earned it. Your taxes aren't due at the end of the year. They're due quarterly. So if you wait until the end of the year to file your taxes and you haven't made any estimated taxes, you're already late. You're going to pay a penalty and you're going to pay interest, whether you file an extension or not. If you file the extension, you're just going to look at more interest if you owe. And if you need getting help really, ready really quickly, I can help you with that. Estimated tax payment deadlines are April 15th, June 15th, September 15th, and January 15th. I did not do that out of order. January 15th is for the fourth quarter. All right, estimated tax payments are very important to you guys. So a lot of people just decide that the penalty is it's not big enough to worry about, and they want to wait till the end of the year and just file at the end of the year and see what happens and what it is. That's okay if you're not making that much money. But if you had a really great year, it's really gonna suck when you do your taxes and if you didn't make any estimated tax payments.
Sure does.
Yes, it hurts so bad. I cannot tell you enough. So this is your own way of withholding your own taxes, because that's all withholding is when you're at a W-2 job. They're making your estimated tax payments. It's not how much you owe necessarily. It's not enough or too much. It's an estimate, right? That's why you get a return or a refund or you owe, because we're guessing really. The way you want to kind of anticipate how much you should owe for your estimated tax payments is look at it kind of quarterly. This is another reason, we're going to talk about this in a second, that you want to go over and keep track of your expenses as you go, and don't wait till the end of the year. I know. That's my number one piece of advice, because I know that when I was self-employed, I didn't do that. But you're going to save yourself so much of a headache, and I know it's difficult, but keep track throughout of the year, and then every quarter you can know what your actual net income was, so that you're not paying the 15.3% plus I'm going to fall into this tax bracket, I'm probably going to be paying this much in taxes, and estimate that. 25 to 30% is usually a safe number. I added the portion of the rental income here, right? Because have any of you ever owned a rental property? Yeah, there we go. Or if you're planning on owning a rental property. Residential rental property is passive income. So it's not active income. This is important to remember, because if you have a passive loss, meaning that you spent more than you charged in rent, and it's a loss, you can only take passive losses against other passive income. So you, in other words, cannot take that loss against your regular income the way you can with active income. It can be on, if it's a single house, apartment, condo, mobile home, vacation home, or similar. Airbnb is not included in this. If you rent it out less than 7 days at a time, then that's short-term rental, and that's active income, and that goes on Schedule C. That loss you can take against your regular income, which we'll go over that in a minute, but that's different. That's treated separately. This is just for long-term residential rental income. It goes on the Schedule E, and you're able to rent it out for fewer than 15 days without having to report it out. If you have if you have a river house and you rent it out 14 days out of the year, you can still claim that income without having to report it on your taxes. Okay. So this is kind of where I was at. I jumped ahead a little bit, and I apologize. This is where it's passive. Even if you materially participated, materially participating means that you contribute a certain amount of time into it, right? And you're really working at it like it's a job. It's still going to be passive income. The magic wand that turns this into active income is if you are a real estate professional. And I do not mean real estate agent or realtor. The term...
Oh, no? Okay, sorry.
No, so you're fine. But
I would have jumped to that conclusion myself.
Exactly. Real estate professional is a term that the IRS came up with that means that you are spending a certain amount of time, I think like 500 hours, I don't know off the top of my head, like 500 hours at least working on finding properties, maintaining your properties, and being, a property manager essentially. But being a property manager doesn't necessarily mean you're a real estate professional. So you have to spend more than half of your time doing this. So a lot of times being a W-2 employee full-time, you just won't qualify for that because the IRS is going to say there's no reasonable way that you're spending half of your time doing this only. So, but if you can get there, like I have a few clients and they do qualify for real estate professional because they're retired, but their husband still works. They're retired and they have multiple rental properties and they spend all of their time doing this. She keeps beautiful records. You should all aspire to be her. She's gorgeous. I love doing her taxes. But one of the big benefits that does is it takes your active or your passive income and turns it into active income, which means it turns your passive losses into active losses. And so you can deduct them from your W-2 income and lower your taxable income that way. That really, really, really only comes into helping when you have a very large loss. And something that people are starting to do a lot more now is called cost segregation. I don't know if y'all have heard of that, but it basically has to do with depreciation, and you can basically take a lot of expenses on depreciating things in your home a lot quicker instead of doing the house as a whole over 30 years, 27 and a half years. I'm not going to go much further into that, so we're fine. But basically that's how that works. Does anybody have any questions on rental income or how that works?
When I get there, I will.
Okay, sounds good. Sounds good. So we help a lot with rentals and short-term rentals. So if you guys have any questions, just feel free to give me a call. Okay, so going into Schedule C deductions, really these aren't just Schedule C deductions, these are business deductions that you can use. So if you are an S Corp, you can still use these deductions just the same. I will say the biggest difference is actually these two categories is you just claim them differently on the S Corp, but you can still, the idea of them. So your vehicle expenses and vehicle usage. On the C schedule, you want to keep track of your business miles that you're driving for, and you guys as realtors drive a lot, and so this is going to be one of your biggest expenses that you're going to have. So you want to keep track of this in a good way. If you don't have, I guess she said Stride keeps track of it. MileIQ is a good one. I think you have to pay for it, but it does give me the document that I need at the end of the year, which is helpful. Yeah, QuickBooks does that as well. You can either use the standard mileage rate or your actual expenses. In either situation, you're going to have to calculate what business percentage you used of your car, because how many of you have a separate vehicle just for real estate and nothing else? Perfect. That makes it easier. Most people don't. They use their personal car, right? And there's nothing wrong with that, but you just want to be able to, yeah, right? You want to be able to allocate what was a business mile and what was the personal mileage so that you can find out how much of your actual expenses you can take on your taxes, because that's going to be what determines that. So if I spent $10,000, but I only use my car half the time, well, then I can only take $5,000 off of my taxes. Normally, the standard mileage rate is the better deal, and it's much easier because then all you have to keep track of is your mileage. If you do the actual expenses, you have to keep track of gas and repairs and maintenance and all these other things, and your mileage as well. So, and usually dollar amount wise, it comes out better to just do the mileage anyway. But you can always try both and see how that goes for you. If you do actual, then you can deduct your vehicle. A lot of people think about that as an opportunity. Oh, I'm going to buy a truck in the business name and write off the whole truck. The only problem with that is if you're not keeping it over 50% of business use, you're going to pay that depreciation back, just like when you sell a house. There's always wherever you have depreciation, there's depreciation recapture. right? So it's not like you can just write off your truck. So keep that in mind. If you have any questions on that specifically, then I'll go over that more.
Doesn't it have to be like brand new and?
There's a bunch of other, so there's other rules that go along with that. And you can still depreciate your vehicle so it's the first year it's in business use is really when you do it. But you can't do the bonus depreciation that everybody else is thinking of. Oh, I can write off a whole truck in 1 year. That's going away anyway, but you can still depreciate it over 5 years. But anytime it's going to go under that 50% business use, that's when it's not considered a business vehicle anymore. You have to repay back that depreciation, or if you sell it. So keep those things in mind. If you don't keep cars for very long, it's probably not a good idea to do that.
So for that, is it after a certain amount of time that it's not, like is it a 5-year mark, or what's the?
It depreciates over 5 years.
Right, okay.
So what depreciation does is it reduces the basis of your asset. So let's say I bought a truck for $50,000. I depreciated the whole thing after 5 years. My truck is now worth $0. The basis is zero. I've depreciated the whole thing. I sold it for $25,000. If I didn't depreciate any of it, then it would have been a $25,000 loss. But because I depreciated the whole thing, that's a $25,000 gain that I now am claiming on my business taxes. So just something to think about. If you want to avoid that in every circumstance, pretty much, always go with the standard. It's easier. If you really want to strategize and be more into it and do the depreciation, that's fine. And the depreciation isn't bad. It just is a caveat. You have to understand how it works before you go into it.
So if you like wrap your car or like put all your branding.
I'm going to go over that because no, ma'am. No. Wrapping your car with advertising does not turn all of your personal miles into advertising costs. No, ma'am. But you can write off the cost that it took to wrap your car as an expense. You can do that. That's advertising. That's fine. But no, it doesn't turn it into a
But does that fall under vehicle
mobile
usage or marketing?
Yeah, does that fall under vehicle usage?
Or marketing? Just regular expenses?
It's still gonna be vehicle mileage. The mileage is still gonna be the vehicle mileage expense, and the wrapping of the car cost is gonna be marketing.
Okay, so separate.
Yeah, so it's separate that way, but it doesn't transform it's not like it's 100% marketing all the time. So you don't get to claim all of your personal mileage as now marketing. It don't. I'm sorry. But yeah, no. So I knew what you were going to ask.
I know, you did.
I know. So same with the home office. So
You hear people saying that all the time.
Exactly, yeah.
And doing it, honestly.
Yes, and I've helped people through audits where they follow advice of tax advisors online, and it didn't apply in their situation, and they owed a lot of money to the IRS because they were following advice. Most of the time, I just go on the IRS website and find an IRS publication that has that, so I can substantiate it and save it and know that I am following the rules, and if they come after me, I'm going to throw this back at them. Mm-hmm. That doesn't always work, because even sometimes their publications, they say this isn't, or like their news things. Exactly, or they say this isn't, they put a disclaimer and say this isn't tax law. Like, so, grain of salt. Mm-hmm. You know, we're doing our best. That's all we can do, right? We're just doing our best. So a home office. So I'm sure that you guys use a home office in your home. There are specific rules to that as well. You can't just have a computer set up in your living room or your kitchen or your kids' playroom or your spare bedroom and call it a home office. It's got to specifically be a designated space only for that activity. And it's got to, it can only be used for that, basically. So I have a client who does things in her kitchen. She can't claim a home office for her kitchen because she doesn't, that's a shared space, basically. If you have inventory or storage, and that's the only thing that's kept for storage in there, like if in your garage or your crawl space all you have in there is signage, then that's okay and you can claim that, and you're going to do it by square footage of the home. Now there's also simplified or actual expenses involved in this. And again, if you use actual, then you are required to claim depreciation on your home. That's dangerous because when you go to sell your home, we were just talking about this earlier, you can exclude, if you fall into the guidelines and the rules of excluding your home sale, you can exclude everything except for unqualified use, which would be business use of your home, which is a rental property or home office, and whatever depreciation you took or could have taken. So it doesn't matter if you did actual expenses, but you didn't take depreciation in that year. You snooze, you lose. You're still paying back that depreciation recapture when you sell your house. So I advise and be like, listen, if this is just your kind of like you're not sure if you're going to do this for the next 20, 30 years, and you don't know if you're probably not going to sell your house, then that's fine. And it's probably going to be worth it for you. You can get a higher deduction by doing that. But if you really are going to be you're not sure how long you're going to be doing this for or whatever, just take the standard and keep on moving. You get up to $1,500 of a deduction for this. So depending on the square footage that you use. Also, the space has to be, every time I go to say it, I forget what I was going to say. It's got to exclusively be used for it, and it's got to be your primary location of where you're working too for the business. So it can't be like, oh, I go home and I do this, but I work during the day in the office. You can't really do that either. Any questions on home office or mileage?
Do you know the I think you said a standard percentage.
Yes, so you can do, I had written it down, nets, I deleted it. It's $5 for every square foot up to 500 square feet, so a maximum of $1,500 of a deduction.
1,500?
Mm-hmm, yeah. Other expenses, dues and subscriptions, another biggie for you guys. Because you have a big old one for fire dues, MLS, software, other things like that. That is where a lot of your things are going to go, so don't forget to do those. Client gifts. This one's tricky because y'all give client gifts, I'm sure. At every sale, you probably give a client gift. You're only allowed on your taxes to claim up to $25 per person. Who spends less than $25? Nobody, right? So what you can do is you can turn it into and say that it's marketing and putting your name and your brand on it, and then that's technically not a gift. So this would be like for like a gift card, right? Or a bottle of wine or something like that, right? But then you can include a larger gift, like I remember someone at the FAR thing, they were selling knives and they had engraved like your name and things on there like that. That, cutting boards, I can't get out of the kitchen, but you know, what anything else you put your name on it, that's going to be then marketing. And then also that can be counted as advertising, obviously your business cards, websites, Facebook ads, anything else like that. If you could put your logo on polos or anything like that, and you can expense that way. I was going to say food, because meals has a limitation as well. So if you are, it's kind of a weird example, but the way that the IRS puts it is if you're giving away food to the public as part of a promotion, then that's included as advertising and not meals, and it's not subject to that 50%. So continuing education, you all are required to do the continuing education. That is a reasonable expense. Regular education is kind of a tricky one. That one's kind of a gray area. But if you can substantiate that your college education that you're getting is specifically for your career, then you can write that off. But it has to be you got to make sure that you can prove this. Meals, if you are treating a client to lunch, if you are, it's not for getting coffee on the way to a showing. That doesn't count. You have to.
Yeah, it might be rich.
Yeah, right? And even in that case, it's subject to 50% of the limitation. So say you spent $500, you can claim up to $250 of that. Entertainment is not deductible at all. Never going to be deductible. So if you buy, they even have a specific saying in there, is if you can classify something as either entertainment or a gift, it's going to be entertainment. So stinkers on that. I'm sorry. Things that you can't deduct are membership fees to country clubs, golf clubs, athletic clubs, airline clubs, things like that. It might be helping you with networking, and it might be helping you in other ways, but at its core, it's entertainment, and you can't deduct that. But you can do membership fees to, if you're on the board of directors of something, if you are in the Chamber of Commerce, if you are a member of FAR, those things you can deduct because those are more directly related and they're not personal. There's no gray area there. You also, I'm sorry, your clothes are not going to be a business expense, y'all.
That's why I'll never have moved a car.
Or your nails. Yeah. Or your nails. Or your hair.
Get donation
I don't wear heels.
credits when you donate to clothing.
Well,
In the arse.
that's
I
not.
wear waterproof swirls when I go hiking.
Yeah.
Unless
No, I know
branded,
it's
you said,
totally
right? They
different.
have to be branded.
The rule with that is if you're going to claim any kind of clothing, it can't be something that you can wear on the street. Meaning you can wear anything on the street, right? But I can wear this anywhere, and it's normal clothes. No one's going to look at me and be like, why is she wearing her scrubs at dinner? You know what I mean? If you can look at someone and identify what they do, then that's pretty much going to be an expense because he's wearing a doctor's coat, he's wearing a lab coat, he's wearing scrubs. Exactly. You're only wearing it when you're working. You're not wearing it on the street. A uniform for a military, like things like that. That's why military can deduct their uniform. And if you're in the field of like construction, that's where it starts to get like a gray area because you need to wear things like, obviously that are specifically for that. But anything that y'all are going to wear, I'm real sorry. It's not going to be deductible. But you can if it's branded. Yep. It's going to be advertising again for putting logos on things like
What about
that.
expenses for travel?
Yeah, so you can do, I don't think I included travel, but yes, there is travel expenses that you can do. So if you travel and you go to a conference or a training or something like that, then your airfare, your hotel, the food there, that's all going to be covered under travel expenses. Yeah. Ubers, parking, tolls, all that stuff is covered under travel. So that's a good one. But if you're just driving to a showing that's far away, that's just going to be mileage that you add to it. All right, so there is, like I said, there's a bright side to self-employment. So a couple other things that you get, that 15.3% really sucks, but what you get is you get qualified business income deduction, which is QBI if you've heard of it before. Section 199A is also what it's called. It takes 20% of that net income that you have for your business and it puts it back on your 1040 as a deduction from your taxable income. So it's not credit, but it's a deduction and it reduces that income. You also get as a deduction, it takes that tax for the 15.3%. It figures out half of that and it puts it not as a credit, unfortunately, but it puts it as a deduction from your taxable income. So it doesn't directly cut the taxes in half, but it reduces your taxable income at least by half of the amount of your self-employment taxes. And if you had not a great year and you think, wow, this really sucks and I didn't get anything from this, you can still put your deductions in there. You can still put your expenses in there. Say you only made $400, but I spent $2,000. You take a $1,600 and it's going to show up as a negative on your 1040 and it subtracts from your W-2 income, thus lowering it. So there's still a silver lining there. What would you have figured out it did?
Right.
Number one, call me. I help you. So we deal with auditing, we deal with nasty letters from the IRS, we deal with all kinds of these things, and we're equipped to handle them for you. The real number one is prepare to be audited at all times. What does that mean? Keep track of your expenses as you go. Keep your receipts, keep your invoices. Because you can have bank statements. I'm going to go over this on the next slide and more specifically. It won't necessarily be enough for the IRS. You want to make sure that you're keeping your detailed explanation and proof, basically, of what you're spending and how it is a business expense. If it's something that could be a gray area where it could be personal, then it could be business, jot it down at the time and keep a log of, just your operations in general and say what this was for and why it's a business expense. So what does that process look like when you get audited? You're going to get a letter. It's going to say you're being audited or reviewed. You're in review. And it's going to send you a list of items, probably from your Schedule C, unless you're being audited for something else, which isn't very common. If you forgot to report something on your return that was a tax form, say you forgot to put capital gains income on there, they're going to send you a letter and they're just going to say, we see this, that you forgot this, is that right? If you agree, say yes and pay us this amount, which is the difference of the tax, and they're probably right, unless there's a basis we can throw in there and fix it. Or if it's something more specific on here, then it's going to be audited. It's going to be because, most likely, they're questioning the amount of the expenses, they want to see proof of it, and they want to know why it's a business expense and not a personal expense. So what you do is you respond with enough documentation to substantiate the cost, and if necessary, an explanation, which I can help you type up, is how it is a business expense and not a personal expense. So what is enough documentation? What does that mean? So the IRS will say bank statements are part of the sufficient documentation. Even on that letter you get, they're going to say, send us proof in the form of not including, but not to limited, what am I trying to say? Including but not limited to, including but not limited to bank statements, invoices, receipts, email, journal entry, whatever. Bank statements alone is not going to be enough. You're going to send it over there. It's going to take a couple weeks, maybe even months for processing. They're going to send you another letter back and say, this wasn't good enough, send us something else or pay this bill. So you're just, to save time, all they're going to look at when they see the bank statement is where you purchased it from and what the amount is. It doesn't show what the item was. It doesn't show why you purchased it. So if you're going to send bank statements, send the invoice along with it to substantiate that. And that's why you want to keep your invoices, receipts, journal entries even better for all expenses as you go throughout the year. You don't want to have to scramble at the last second because you're going to be scared. You're going to be embarrassed. You're going to feel shame. You're going to be a nervous wreck trying to get all this stuff together. And you're going to, if you don't have it all together already, you're going to forget where you got that expense from. You're going to forget where you purchased it from. You're not going to be able to find it. You're not going to know where your receipts are. It's going to be a mess, and it's going to be much more of a difficult process for you. So if you keep all that organized and you have it all ready, then you're going to be fine.
Or if we hired you, you just handle it.
I'm going to still, no girl, no. I'm going to look at you and I'm going to be like, I need your invoices. That's what I'm going to do. I need your invoices and I need all this stuff together. So you do have a responsibility as a business owner to have your record keeping. Also, the IRS it's kind of scary. Don't freak out, y'all. The IRS has a couple years to audit you. So even if you do your return and it gets accepted by the IRS, that doesn't mean that it's correct. That doesn't mean that everything is all good. They have at least 3 years to look back and say, in 2022, you wrote this. We accepted it, but now I want to see proof for why. And you got a $10,000 return. So if you owe if that was wrong, you're going to owe us the difference back. You got to pay back your return because that wasn't really your return to begin with. So don't wait till don't wait. A lot of people come to us and they're like, I'm being audited. The letter they got was sent 2 years ago. I know it's a scary process. I know it's a shameful process. You don't want to ask for help. You want to try to handle it on your own. If you really can't handle it on your own, immediately go find someone to help you out with it, because the longer you wait, it's a lengthy process anyway. The longer you wait, they're just going to keep adding on interest to your bill. The interest doesn't stop just because they're investigating it. The interest is still going to keep on building up there. So just do it as soon as you can. You as a taxpayer are responsible, and this is also in our agreement, you are responsible for your own tax return. Okay. So you signed it saying we could file it. You can't really claim ignorance a lot of the time, unfortunately. Yeah. So if you signed it, then we filed it for you, and that was accurate because we said everything you gave us was accurate. Now, if we did something that I've seen a lot, I don't do this. I don't do this, y'all. Don't ask me to. But adding a C schedule where you don't really have a business, and getting expenses so that you can lower your taxable income, doing things like that. Something that's very fraudulent like that can sometimes come back on the tax preparer. But for the most part, especially if it's an expense that you gave us and it wasn't categorized right on your end, we kind of have the protection on our end where it's like, well, you have the responsibility of your tax return. You said that everything was accurate. So, yeah. But so there are ramifications, but most of the time it comes on the tax preparer. Yeah. The last thing in here that I have for you is just to avoid scams. I always throw this in there no matter what, because the IRS is never going to call you. They're never going to say that you owe them money over the phone, and they don't email or anything like that. Also, if you get something in the mail, I've had people are trying to get sneaky with scamming stuff. So read where the actual source is from. And if it's not from the Internal Revenue Service with the address and all that stuff, but it says you owe taxes and it's like something like that, and then you open it up because you're scared and you see that it says like in like parentheses like Credit Karma or whatever. Yeah, this is not tax bill, or like this is a pay credit avoid tax thing, whatever the company name is. You're like, all right, well, this isn't from the IRS. You can also always go online to irs.gov and go into your online profile. If you don't have one, just create one and all your information's already in there. And you can see what your tax liability is that way. But yeah, they'll mail you something. They won't email you and they won't call you. So that's all I had. Do we have any questions? Yep.